Hey guys, David Robinson here. Welcome to the apartment investing journey. Here we are, another week and another great guest on the show, someone that I've been excited about having come on the show to talk about his journey. He's got a great story and a lot of experience to share with you. And so, Kent Ritter, welcome to the show. I appreciate you coming on.
Thanks, David. I'm glad to be here, man. Thanks for having me on the show.
Yeah, my pleasure. My pleasure. So, a little bit about Kent. He is a former management consultant, startup owner, and corporate executive who has turned full time real estate investor and operator. Kent is the CEO of Hudson Investing, a multifamily investment firm which helps busy professionals scale and diversify their real estate portfolio. Kent has achieved financial freedom himself, and now he's on a mission to empower others to do the same through multifamily investing. So, Kent, that's the very brief bio, right? There's a whole journey behind that financial freedom and
Yeah.
building your own company. And we want to hear about that. Our goal is to sort of tell the stories of successful entrepreneurs and investors so that our listeners can sort of fast track their success. And so, if you don't mind, let's back up and let's talk about your journey. When did this journey start for you?
Yeah. Happy to get into that. And I would just say before I do that, I think that's it's a great topic for the show. That was really how I got started, was by listening to people, on podcasts. And so now it's going to come full circle for me, but it really was the podcast talking about people's journey, what they did, how they got there, how they got over their limiting beliefs, and ultimately what they were able to do that really inspired me when I was first setting out to get started. So yeah, hopefully in some way my story can inspire others, and everybody can reach that financial freedom that they're looking for. So I think it's one, just a great topic for the show. And yeah, with that, as you dig into my story, so I typically start back at like you said, I was a management consultant, and so I came out of school, moved to Chicago, and started my managing consulting career. And really, as a management consultant, what you do is you fly around the country helping companies solve their big problems. That they hire us when they had problems that they couldn't solve themselves. And so it was really a great learning experience. And that was really why I got into it in the first place. I always wanted to be an entrepreneur, and I always had this entrepreneurial streak. But in college, it's kind of like I knew I wanted to run my own business, but I didn't know what that business should be. I didn't have that idea yet. And so I saw consulting as a way to really just learn a lot about a bunch of different businesses, and get to see the insides of them, and learn how to solve problems, and work with some really smart people. And so that was really what attracted me to it. And that's exactly what happened. Was I worked for hundreds of different companies, many of which were in the healthcare space, and just got to see inside, and got to see what worked and what didn't work, and help them solve some of their big problems, and learn really how to manage large scale projects, how to manage change. Change is constant in our lives, but difficult for everyone. We're, as human beings, we're not good at managing change. But so learning how to help people through that process, learning how to inspire people and get people to move in the direction you want to, all those things were really great soft skills I picked up, but also just an understanding of kind of what levers really drive business, and what things can you pull to really make change, and definitely saw commonalities through my experiences on kind of what really works and what doesn't. And so that was a great baseline and education. And at the tail end of that career, several colleagues and I left to actually start our own consulting business. And so we started a boutique firm based out of Chicago. It was literally like five guys around a kitchen table to start, like you think about in a startup story. And we grew that to 95 employees, had to leave the kitchen at that point, got our own office, and about 30 million in annual revenue. And it was a fantastic run over about a 6-year period. And in 2015, we decided to sell that business. And that was really what launched my real estate career, because I had this capital from selling the business, knew I didn't want to be just 100% in the stock market and kind of riding that roller coaster. And so I started looking for alternative investments, and real estate really just spoke to me. And as I started meeting with people, anybody that I knew in my immediate network that was involved in real estate, wanted to sit down with them, talk to them, started just learning about different aspects, different asset classes, different ways of investing, tried out a number of different things, ultimately landed on multifamily, because multifamily really, for me, checked all the boxes. And those boxes for me initially from an investment perspective were, I wanted something that was non-correlated to the stock market. I wanted something that provided cash flow and passive income, so that I didn't have to maintain a W-2 job. I wanted an investment that would appreciate and appreciate well and build wealth, and then the kind of the icing on the cake that I didn't really realize at the time as much were the tax savings, and those tax savings really have been extremely impactful for me and other real estate investors. So those things really checking all those boxes. I mean, multifamily became the focus, and decided to go out, and I was going to go acquire my own property and kind of run my own property and be a landlord, which isn't really much better than being a landlord of your own single family. You're still dealing with toilets and tenants and all the problems, and it's just not scalable. So before I did that, luckily I had a mentor step in. I've had mentors step in at kind of key points in my life and say, well, what do you do once you buy that? And I'm like, well, what do you mean you run it, it gets cash flow? He's like, yeah, but you're out of money. All your money is stuck in this one building. All your eggs are back in one basket. And, there's no growth from there. And so he taught me about syndication and about what that means. And syndication, really simply put, is just pooling our money together to go buy something bigger and better than we could on our own. And when I learned about that, like the light bulbs went off. I'm like, man, this makes so much sense. And I learned I could invest with others who are experts in the space versus me trying to dabble and figure it all out on my own. And so that's what I started doing. And really, like 2016 to about 2019 was passively investing with others in syndications, and just using that as part of my education on just learning about real estate. I mean, I didn't grow up in real estate, right? I didn't get into real estate till like 2015. And I think I've done a heck of a job ramping up and learning since then. But it was really just every podcast I could listen to, every book I could read, went through 2 formal mentorship programs, found a few other informal mentors, and just tried to digest everything and then learn through those investments and ask those questions to those sponsors, like, why did you do this? Why did you do that? Right. And take what I liked and leave what I didn't, as I look to apply it to my own business. And so in 2019, I went out and co-GP'd my first syndication, meaning I was actually on the active side. I was helping out. I would say, I wasn't leading it. I was very much like sitting shotgun to some folks that were more experienced, and I was able to learn from them. But at least I was in the front seat, right? And I was making some decisions, and I was helping them out. Then in 2020, moved on and did several more deals. And in 2021, we've done one deal, have another one closing in a couple of weeks, and then we have 2 more under contract. So we're just continuing to roll and working on my 7th syndication at this point.
Well, congratulations on the success, and thanks for giving us some background into your story and your journey. A couple of things I wanted to pick up on. You spent a significant amount of time from your exit of your business before you went active as a passive investor. Were you exclusively focusing on passive investing? Were you involved in other ventures at that time? What did your life look like between roughly 2016, 2019 for those 3 to 4 years?
Yeah, it's a good question. So from a multifamily standpoint, it was really focused on passively investing with other sponsors. And finding good investments, and then really just learning as much I could, because I recognized that I think I'm self-aware enough to know, like, there was a lot I didn't know, right? And there was probably a whole hell of a lot I didn't even know I didn't know, right? And I didn't want to enter into that, and make some massive mistakes, especially taking on other people's money, which I take extremely seriously. I mean, it's one thing to lose my own money. It's a totally different thing to lose other people's money. I mean, it's just not something I would ever want to feel unprepared to do. Right. So it really was about, that learning experience from there, and kind of figuring out exactly, I mean, just everything that there is to do it, because there's a lot that's involved. And I'm the type of person that my wife will give me a hard time for this, because like she says, like, like if we need to buy a new TV, it takes me forever to buy a new TV because I want to look at like 40 TVs and I want to understand all the specifications and all the things. And like, and it's like same thing. I was just given I give my insurance broker, like, I mean, it's just such a headache because like, he's like, most people, I just give them a plan and they sign up for the plan. He's like, you want to go through every detail and understand every aspect of this and like what it is. And like, well, yeah, I want to make an informed decision. Like I want to know what I'm signing up for here. Right. So it's kind of the same thing of me checking all the boxes and feeling really confident that I knew what I was doing and that I could be successful in it. And that took me some time. Now, I was also doing, I did a host of other real estate related things during that time. Just trying different things out. I had a family friend who was doing a note buying strategy. And so I dipped my toe in that. I bought a few houses and sold them on contract and held the notes and that was okay. But at the end of the day, like collecting on those principal and interest payments is just as difficult as collecting rent. It was the same thing, really. You got to follow up with people and make sure you get them. So, and the real kicker was when I, like 2 years into one of them, I got the closing statement because the guy had sold his house and, I'm on there because I'm getting my debt paid off and that's cool. I got my loan paid back, but that house had doubled in value. And in 2 years, that guy had doubled his money in his investment. I'm like, man, I need to be on the asset side of things. I need to be purchasing assets, not just owning the debt because I really want to grow my wealth, not just, I think debt is a good like preservation tool, and it could be a good cash flow tool if that's what you want, but I really wanted to grow my wealth and my nest egg and got to buy assets. So, I tried that out. I did dabble into some fix and flips and have done several, and that's been fine, but it's just, it's not scalable. Again, it's really difficult to scale. I mean, people do it, but it's difficult. And I'm not a contractor by any means. So I was heavily reliant on others. And, and then I did build out kind of a small single and duplex rental portfolio, just kind of on the side over that time. Never intended to be the core business, but just some extra cash flow and an additional income stream. So those are some other things that I did during that time. But yeah, the main focus was just learning multifamily.
Yeah. Well, and I appreciate you, shedding some light on that time frame where you're exploring a lot of different investing strategies, it sounds like. And multifamily, it seems obviously that was the one that fit your goals and long-term strategy, wealth building, cash flow, the appreciation non-correlated to the stock market. For the listener that's in that phase, that maybe they have explored a handful of different strategies and maybe they need to refine or get a little bit more clear on their investing strategy moving forward, what advice would you give to someone who's maybe in the small multifamily space, single family space, and exploring getting into multifamily, whether it be as an active multifamily, large commercial multifamily investor or passive multifamily investor? What advice would you give that person?
Good question. So I think it has to start with what are your goals and what type of lifestyle are you looking for? Like one, if you want to be active, like, is this something that you want to do day to day for the next, 10, 20, 30 years, right? Like for me, like I want to syndicate apartments for the next 30 years. And I know that. And so I should be active and I am, right? But I think you got to start there and say, okay, well, do you want it to be your full-time job? Or do you want it to be something that you do on the side? And so one, it's like, okay, how active do you want to be? And I think you have to understand what level of control are you comfortable with, or then the opposite, like lack of control are you comfortable with, right? Because, you could buy a single family home and rent that out and have complete control over that and manage that. But the difficulty is that's not a scalable process. So if your goal is to create, a $10 million net worth, that's really difficult to do in single family house terms. That's a hell of a lot of houses. You start to do the math on what that takes. That's a lot of houses. And And one thing that I think is 100% true is like, it's easier in many ways to buy a large apartment building than it is to buy a single rental or even a quad, and because you can have professional management, there's more debt sources. There's non-recourse debt sources where you're not going to be personally held accountable, right? You're not dealing with just community banks. And really, from a closing process with title and everything else, you're going through the same motions, just with a larger property, but it doesn't really add that much additional time and effort. So it may seem counterintuitive, but in many ways, larger multifamily is easier than smaller. So I think that you've got to think about, okay, what are your goals? Like, what do you want to achieve from a wealth standpoint? And then you have to align your strategy with that's something that's scalable enough to get you there. Now, if you just want to have a small portfolio to kind of supplement your income and you want to have a lot of control, then it might be buy a small multi, and manage it yourself and keep your W-2, because that's just your vacation money or whatever, right? And you're kind of comfortable, where you're at, and you just want to supplement your income. So I think you got to understand your goals. And I think those drive ultimately what your strategy should be. But if you want scalability, and by scalability, I mean the ability to like amass a lot of units and a lot of wealth, and also the ability to start to offload things like management, you're gonna need to look into larger multifamily. And then you say, okay, well, in larger multifamily, am I comfortable giving up control to someone else? Or is it something that I feel I need to do on my own? And again, I think that goes back to, do you like your day job? Do you not like your day job? Do you love real estate? Like, are you passionate about going out and doing this? Because if you're doing it, I think just for the money and just because you can't give up control, but at the end of the day, real estate's not really your passion. Like, that's probably not the right path for you to go out and actively syndicate deals and take other people's money and put all that burden on your shoulders, because it's not the least stressful job in the world. Like there's other things you could do, right? So if you're not doing it for the right reasons of like, you really love it, I think you should look passively. And then I think with passively, the problem is you got to get over that control thing. And you got to know that you're giving up control, but you're aligning with someone who has more expertise than you. And even though you're not making the decision, you're trusting them to make the decision. And passive investing also gives you the ability to have more diversity, right? And to spread out your investments among other things. And you can have different sponsors, you can have different geographies, different asset classes. Like for me, I don't invest passively in multifamily anymore, but I still invest passively in things like industrial and medical office, because I'm not an expert in those things. I don't focus on those things, but I want exposure because those are well-performing asset classes. So, you've got to kind of take your goals, your control tolerance or lack thereof, your passion for real estate and all those things, and bring those together, I think, to find the right strategy.
Yeah, that's great advice. And thanks for taking some time to sort of walk through your thought process and giving our listeners some advice. I want to push the conversation forward a little bit, and I want to talk about Hudson Investing. And what does your business look like today? What are you focused on? What do you see in the future for Hudson Investing?
Yeah, Hudson Investing. So we focus on finding mismanaged and undervalued properties throughout the Midwest. And the properties that we're looking for are Class B and C properties, typically suburban garden style properties built typically between kind of the 70s to the 2000s. Where there's a value add component, where we know that we can come in and we can identify specific areas where we can make changes and we can increase the value of the property. So mismanagement is one of my favorites because that doesn't cost much money to fix. So, a lot of the folks, the buyer or the sellers that we'll target are, mom and pop sellers, folks who, and what I mean by that is just folks who maybe only own one asset, maybe manage it not as their full-time job, right? Typically those folks will, they want something that is easy and doesn't take a lot of time. So typically they maximize occupancy, but they fall short on really maximizing the revenue and the profit on the property. So they'll keep it full because when you keep it full, there's not a lot of headaches. But
Right.
oftentimes they'll be $100, $200, $300 below the market in rent. So when we look at that and do our rent survey, then we see a clear opportunity to just bring them up to the market. I mean, that's a no-brainer, right? And so that's a deficiency that we know we can come in and solve right away. And so we love finding properties like that and buying from owners like that. You know, it can be a little more, the process can be a little more difficult because oftentimes they don't have great financials. There may not be a lot to go on. So we're often relying a lot on our experience and our past properties and to benchmark and to say, well, here's what our expenses would be. Here's how we would run it and kind of put our pro formas together. But we have that knowledge base to be able to do that. I mean, we know how much it takes to run an apartment. We know how much things cost to rehab. And so we can kind of put our own together with fairly limited knowledge of what they've got going on. So we love buying from that throughout the Midwest. We have properties right now in Indiana, Ohio, and Kentucky, and we're continuing to expand out, but also really focus in on those markets and in those major cities like Indianapolis, Louisville, Kentucky, Lexington, Kentucky, Cincinnati, Columbus, Dayton, Ohio. All those places have really strong growth, strong job growth, strong rent growth. I mean, we're seeing a resurgence of growth in the Midwest. And honestly, there's just not nearly as much competition here. And that's part of the strategy is, you know, well, let's not fish where everybody else is fishing. Right. And so a lot of people now are through advice or just because of the hot markets are focusing in places like Texas and Arizona or throughout the Southeast and Florida. And it's just hyper competitive. And so we see an ability to just kind of own our backyard, right? And leverage the local relationships that we have, but also as a diversification play for folks, when they go out and they look at 30 syndicators and they're all in the same 3 cities, and they look at us and they say, wow, we can get exposure to a different part of the country, a different profile, typically higher yields, higher cap rates, better cash flow, right? And so we can be a nice supplement for folks that are too heavily concentrated in certain geographies or certain types of deals, maybe 3 caps versus 6 cap rates, for example.
Yeah. Yeah. I love it. Yeah. I love that mentality of owning your backyard and really becoming an expert in that space. And, you know, there is a natural, I think there's some natural pressure as there's a lot of publicity and conversation and talk about these hot markets, large metros that attract a lot of the large investors. And so being in that space where you can provide an alternative to those markets with that in many cases can produce better cash flowing opportunities. And just dealing in a scenario where you have less competition. I love that. I'm curious from a management perspective on these properties, and it sounds like you mentioned that one of your ideal scenarios is a mismanaged property. What's your strategy as far as moving in and taking over management of these assets? Do you have in-house management that you've built? Do you work with local boots on the ground operators and managers in those locations? Do you work with the existing management to help them improve? What does that look like for you?
So 9 times out of 10, we're bringing in our own third-party manager that's local to the area and has experience in not only the area, but in the same type of asset class, because it's a very different management company. Just like people, management companies are good at certain things. Some management companies are really good at like the downtown Class A stuff. If you send them out to the suburbs to manage a Class C, they wouldn't perform well. Other management companies focus more on the workforce housing, Class C and B stuff. So we find management companies that are familiar with the area, that have a decent exposure, meaning unit count in the area already. So they know the area in the submarket, and also specialize in the right type of asset class. Because it's just different, just different tenant profiles. It's just they're just different animals as you move up and down in asset classes on these multifamily properties. So you got to find the right manager for the right project, right? But typically we're creating relationships with folks in the markets that are already there. There's a lot of publicity, I guess I'd say, around like vertical integration, right? People, if they are vertically integrated, that they really want to advertise that. And I think there's a lot of pros to vertical integration, but I've also seen the cons of vertical integration. And one of the cons is that you just have too many plates in the air, too many balls in the air, however you want to kind of say it at one time. And it becomes difficult to be really good at acquiring apartments, really good at managing, really good at maybe you've got your own insurance arm, maybe you're sourcing materials, maybe you've got your own construction company. I've just seen in the past for places that I've worked or partnered with where, it can sound really good, but there's sometimes just too many balls in the air, too many and not enough focus, right? And so I believe strongly, and this is like from my consulting background, in like specificity of labor, meaning like just like we talked about property management, right? Like no one's good at everything. Most people are like really good at one thing, and the way you get the most out of people is find out what they're really good at, like what's their superpower, and then like maximize that. Well, like I'm not passionate about property management. I'm passionate about finding great deals and bringing in investors and like changing their lives because I'm making them 2-3x what they could make in the stock market, but not property management. But there are people that are passionate about property management and they love it. And those are the people that I want to find and partner with because I know they're going to manage it way better than I would if I had to build that out from scratch, and I don't have the local expertise, right? And I haven't been doing it for 10, 15, 20 years. And so I find those people and I partner with them, and that allows me to focus what I'm great at and allows them to focus on what they're great at. And as long as we hold each other accountable, it's successful.
Yeah. Love it. Well, you explain your thoughts around the industry very well. And I love your mentality about how you're growing and building your business. What's on the horizon for Hudson? Do you, rinse and repeat, keep focused in the Midwest on those B and C class assets and going that direction? Or is there any pressure to consider different asset types?
Yeah, good question. I've actually been spending a lot of time thinking about this as we've defined a pretty because again, I'm a consultant, so I really like standard operating procedures and policies and all these things. So we have a pretty well-defined like value add acquisition process of being able to come in. We know what adds value. We know what doesn't add value, and we know what we do. So from that point, it is largely rinse and repeat. Now, I'll tell you, we are always looking for new revenue streams that are not just raise rent, right? You can't have only one feather in your cap. So something like one thing that I'm really excited about that we've done on a few properties and are going to be implementing going forward is actually bringing fiber optic internet to the properties and becoming really the internet service provider for the property. And it's really cool because we're able to give the tenants a better product because fiber internet is more stable. It's way faster upload speeds, which when you're doing Zoom and stuff like this matters. So you get up and download speeds that are better, and we can undercut the market because we'll just do a market survey and say, okay, well, Comcast is charging you $60 for their lowest. We'll charge you $50 and we'll actually give you better speeds and make it a no-brainer for folks. So that becomes a great revenue stream. Looking for other opportunities like that where we can add value, but get paid for it. And I like the internet one because the residents are already paying somebody for internet. We just shift that to us and we actually lower their financial burden. So like if you're raising rent, you're increasing their financial burden. We're actually decreasing their total financial burden. We're just shifting that revenue over to us. And so I think that's a win-win for everybody. So that one I'm really excited about, looking for new opportunities like that all the time to create other revenue streams on the property that are not just rent. And then, we've started to expand into development. So there's a couple of development projects that are not underway, but that we're considering right now and kind of going through the initial due diligence and the pre-construction pieces for. So I think there's tremendous opportunities in new development. If you're in areas that aren't where everybody else isn't developing, right? It's kind of the same thing. If you're in a town where there's cranes across the entire skyline, But even though there may be a deficiency now, eventually there's going to be an oversupply. I mean, it's how the real estate cycle goes. But we're finding maybe more secondary, tertiary markets where there's huge demand, and markets where, there hasn't been a new multifamily property built since 1990. And there's just not enough housing to go around. So those markets, we're finding like niche opportunities to do some development. So we're vetting out a couple deals right now, which I'm excited about. It'd be our first process that we go through the development process. And, as far as looking into different asset classes, like outside of multifamily, for me, there's, the idea of like the shiny object syndrome, right? Like I know myself and I've got a lot of ideas, a lot of big ideas, and I have to put the guardrails on and know that I can't chase every opportunity. So I think it's, again, like specificity of labor, specificity of focus, like just be really good at buying and potentially building multifamily and just stay in that lane. I think there's enough there. And then, who knows as things go on. But, the one thing I'll say about Indiana does have the 10th most mobile home parks of any state. And those have had my eye for a while. I haven't gone out and implemented a strategy there, but I think there's, as you think about the lack of affordable housing, the most affordable housing is a mobile home park. So I think there could be opportunities there as well, but not something that we're actively pursuing at the moment.
Love it. Well, Kent, you've been gracious with your time. I appreciate you going into detail about, your journey, how you got started, how you built up your consulting business, sold that off, and then started your foray into a handful of different investing strategies, single family, note buying, fix and flip, including multifamily, and how you leaned into multifamily, saw it as an opportunity that, checked all the boxes that you were looking for, and decided to really pursue it full time as an operator. And, thanks for sharing your mindset around being an operator, being a quality operator on your 7th deal, and some of your thoughts on market and strategy and management. Anyways, just thank you for being willing to share your journey and your insights with our listeners. I want to start winding down here. I've got 3 final questions for you.
Sure.
The first is, what's the biggest mistake that you've made on your apartment investing journey that we could all learn from?
That's a good question. Biggest mistake I've made on my apartment investing journey. Just from an investment standpoint, when I started out as a passive investor, the second investment I ever made, I lost all my money on. And the reason I lost all my money was because the guy committed fraud. And not just me, everybody lost all their money. The guy lost the apartment. And the lesson learned there was I didn't do due diligence on the sponsor that I was investing with. I went on a crowdfunding site and I said, "Oh, cool. That looks like a good market. It looks like a good deal. I don't really know what I'm doing. Is just dipping my toe in the water." And I didn't even speak with the sponsor. I didn't do anything to vet, is this a good person? What's this guy's track record like? Like, has he had any issues in the past? So one thing I would just love to tell people is, if you're going to invest with somebody, like, make sure you do the due diligence on the front end to know that that's a good person. That's a person that, has integrity and is going to do the right things even when nobody's looking. Doesn't have, a shady background, right? Hasn't done things in the past that could be red flags. And also has, I think, a certain level of financial means to support themselves and support the deal in case things, don't go as planned. I think that's important as a sponsor. And so that was a big one. I mean, that was losing.
That's a good one. We don't get too many guests talking about the deals that go south. So I appreciate you being willing to share that.
Yeah. The other thing I would just share, like, from an operating standpoint, is watch your water. Water next to fire is the biggest thing that'll just blow up your investment and your operating statement. I mean, we had a situation on one of our properties in Louisville. This is a huge lesson learned for me, so in Louisville, the water bill only comes every other month. So, there's 2 months until you get your next bill. And so we had a leak it was actually 2 leaks on the property that the tenants didn't, I mean, toilet leaks that the tenants didn't report. And we didn't know about because for probably 6-7 weeks, because the bills only come out every 8 weeks.
Mm-hmm.
And by the time we got that bill, I mean, it was 3x what it should have been. And on a smaller 30-unit property, I mean that can really impact your NOI and your cash flow. And so the lesson learned is, how do you find those things quicker? And then they have tools now where you can put water sensors, on toilets, flow sensors and things. And I think that's a great option. But also just making sure you're working with your tenants to make sure that they're reporting things and just being, and I think even after, because I think like even after we knew about it, we could have acted sooner. We could have worked with property management, could have acted sooner. And I think we let too much time go by before we really jump on it. And now I have a very specific plan on what to do and actions to take, but that was all through kind of trial and error. And so I think just watch your water bills very, very closely, because you can have a leak that's not like these were toilets that were running and they were going down into the pipes. So there was no like standing water. Like people think there's leaks, there's going to be water somewhere. I mean, there wasn't. It was just running and running and running, and the tenants didn't report it.
That's a great practical tip. Yeah. Thanks for sharing that one with us. Last question I got for you. What's the best advice you have for someone that is just starting their apartment investing journey? And I'll throw in the caveat that, when you started 2016, roughly 2019 as an active operator, maybe the market's a little bit different today. Do you have any insight that you would give for someone who's just looking to get started in the large commercial multifamily space?
Yeah, for sure. Well, one, I personally think it's a great time to buy apartments. I think, people are going to say we're at the top. People also said we were at the top in 2014. So,
right.
And you could have thrown a dart at a wall in 2014 and hit a property and you would have made money on it. Right. So I think we actually have a few more years of a lot of runway for rent growth and therefore asset appreciation, both because of rent growth, but also because there's so much cash floating around, both from government subsidies and from cheap interest rates, that people are just willing to pay high prices. So I think we continue to see cap rates compress and at a minimum stay flat over the next few years. So I think it is a good time to buy and enter. I just think you need to think about your hold strategy. If you can lock if you're going to hold long term, lock into a long-term interest rate right now. Interest rates will go up. I don't think they're going to go up materially in the next couple of years, but they will go up. So if you can lock into a 10-year rate now, that's a good strategy if you're going to hold long-term. If you're going to syndicate, I've moved to more 3 to 5 year holds. I've shortened my hold time because I think that's the most clarity. And I think we have a process where we have the ability to affect change fairly quickly. So why not get in, affect change and sell into this seller's market that we have to maximize the value versus holding on just because, I think your strategy has to match the market. But you hear other people's strategy, they're holding longer because of that. So there's different points of view, but mine is we're doing 3-year holds, up to 5 years. And then the other thing I would say, look, if you're just looking to get started in real estate, the number one thing I would recommend is do a house hack, buy a duplex, live in one side, rent the other side. And, in doing that, you're going to offload your largest expense, which is your mortgage. You're going to have somebody else paying for it. It's going to free up to have the freedom to not have to be as reliant on that W-2 and be able to focus on more real estate. And then just do that year after year after year. And 5 years, you got 10 units and you're off to the races, with a nice cushion that allows you to have the cash flow to maybe do real estate full time at that point. So that's my recommendation to everybody when they ask me how to get started nowadays. Like, I wish I would have known that back when I got started, but just house hack.
Love it. Well, Kent, it's been an honor to have you on the show. I appreciate you taking time with us, sharing your journey with us. What's the best way for our listeners to connect with you, learn more about what you have going on with Hudson Investing, and potentially, partner with you or invest in a future opportunity?
Yeah, David, the best way is just go to my website. It's kentritter.com. It's really easy to find me. And you can access my podcast from there. You can access my blog. We've got a passive investor resource page with terms and FAQs and things for new investors to try to make the process a little less daunting, a little easier for folks. And yeah, you can also read about me and my story a little more, and you can sign up to be an investor if you'd like. And you can also sign up for our newsletter, which comes out weekly and just provides industry news and kind of what's going on with me and within the company. And yeah, so that's really home base. And then if you want to just go straight to the podcast, you can find Ritter on Real Estate. It's the name of the podcast anywhere that you listen to podcasts.
Love it. Love it. Well, we'll have all that info in the show notes for all you that are listening. If Kent's story resonated with you, if his business strategy and mindset resonate with you, go ahead and reach out to Kent, kentritter.com. Listen to his podcast, Ritter on Real Estate. Kent, again, a pleasure to have you on the show. I appreciate you coming on, and I look forward to connecting with you again soon.
Thanks, David. Really had a lot of fun. Appreciate you having me.